I got 9.8.
Okay,
I got
who said
9.6. You know, and I
got
used the second
9.8.
formula. I didn't use this the equity from I used total net assets and less current liabilities.
Okay. So I can see total asset net current liabilities. I'm seeing some people 9.6, but we've not gone that. So we are using the first formula, the first variant of yes, equity plus reserve. So I think everybody got 9.8. Somebody said 10.4. Okay, 9.77, correct. That is the correct value aside approximation. So who else got 9.77?
Yes, it was 9.77, so I just rounded it to 9.8.
Yes, fantastic, is correct. So who has got 9.77 or 9.8? Somebody got 10.441, somebody got 10%. It's all correct. So we are very close and I align very much with your decisions. Okay, so let's run to that of the net assets, and let me just take our profit before interest here so that we'll just pick the net assets where we are having it. Okay, so I've picked our profit before interest. So let me go and take our total assets and current liabilities from the question. Okay, so where is our total assets? We have it here. So 1, 2, 1,217, and for this year. Then we take our total current liabilities. Let me pick it also as 46153. Let me pick the 4 figures. I hope those. I paste it here. These are our total assets for 2021, for 2022. Total liabilities for 2021, for 2022. Okay, so let me get the total. Okay, fantastic. So let's get the percentage. I just drag. No, let me don't drag because it's giving me a different figure. All right, so I have profit before interest tax divided by this. Let's do that minus, let's do it manually. 756, okay? 1403 minus 530. Okay. So we now have profit before interest and tax divided by our net assets. How comes I'm having 19%? Different
from total asset. Your total asset is not correct. Your total asset is supposed to be 1853200. Total assets is not correct.
What's the name?
Oh, I beg your pardon. Thank you for that. Yes.
Yeah, total assets. Yeah.
Yes, Julie is correct. Thank you for that. I'm wondering, is it that I'll be the black sheep here? Fantastic. Okay.
Yeah.
You
picked your total liability instead of total current liability.
Liabilities, exactly.
Because I got that 19 before.
Okay, so I picked, I didn't pick the total. I picked the current liabilities correctly. What Julie said was correct. See what I picked here. I picked current liability as, yes, I picked the correct total liabilities, but I picked the wrong total assets. I think I went to pick total current assets.
Okay.
Yes. So Julie corrected me. Yeah, so I've seen the total assets and I've taken the correct one. So I have it now as 1.8 billion and 2.1 billion. So I'm already having 10% like some people. So I'm already.
This your total current liabilities. Can you check it out, please? I don't know if it's correct.
Okay, let me go back to total current liabilities. Thank you. So total current liabilities, I have 46132 and 53030. I think I'm correct.
Okay. Where did I see that one? Okay,
Yes,
maybe I did
that's
not go
correct.
down.
That's
Yes,
correct.
down.
I
You
didn't go
see it
down. I
down.
just stopped.
Page 2.
Okay, I didn't go down. Oh,
Yeah,
okay.
it's on page
Okay.
3.
I didn't see total dividends and preference dividends.
Okay. So
Okay.
that's what I
Okay.
picked. I picked the correct thing. Yeah.
Okay. Yes.
Yeah. Okay, so I have 1,853,200. Then I have this. So this is my net asset, and I have 20%. Then I also have, yeah, so let me do this. This divided by this net assets. Oh, 10% too. So everybody is in line here, because if we go by the
10.43, 10.4.
10.43, 9.6, 10.43, 9.6. So everybody is correct here. It's just approximation. That's fantastic. We have perfect understanding of the rules, so it's good. So everything here is between 9, 10, 9, 10, 9, 10. Fantastic. All right. So that's fine. And we are all in line with the calculation. So aside the calculation, what does it mean? Because it's very important. The rules is one of the frequently tested ratios in the case study exam. So what does it mean? It means that a company is generating returns from its capital, whether internal or external. So why do we add ordinary shares and that of the debt? Is because those are the two kind of debts that has been provided to the business. Don't forget, you can include preference and you cannot include deferred tax liability. Why are you not including them? Because they are not debts. Preference is a special arrangement for special. That's why it's called preference. It's for preferred people. So it's not a debt per se. You must pay it whether you are going down or going up. It's a covenant. While tax liability is something you defer, but you must pay. You didn't borrow it. It's an obligation to government. So those are the reasons. So you only look at your equity, your reserves, retained earnings, share premium, and anything attributable to the ordinary shareholders of a company. So the debt also is the same thing. So it helps investors. It means that it helps investors understand effectively how a company is using its capital to generate profits. So we use the formula here. And what are the implications? A high return on capital employed value indicates that the company is more efficient in generating profit for its capital. It suggests effective management and operational efficiency. So in the case of Dan Kabir, you will see that 9%, 10%, 9%, 10% using both variants is a positive figure, even though it's low. But then anything above, let's say 10 to 49 is low. Then 49 to, let's say, 79 is medium. And 79 to 100 is high. So using the high, medium, low method, depending on the variables you use, a company like Dan Kabir is having low return, but it's positive. It's better than negative. So that when you are explaining the implication, it's low, but it's still positive, and it's an indication that there's future prospect and growth for the company, no matter how little it is. So 9 to 10% return on capital employed for 2020, 2021, 2022 is a positive omen, and it shows the company has sustained that for 3 good years. So when you are making your explanation, don't forget that you talk about the implications, and you may not talk about why it's low, but then this is the reason for a low return on capital employed, as you can see on the screen. It could lead to, it shows that the company is not effectively using its capital to generate profit. So where you have a negative figure or something as low as 0.1, 0.2, very, very low, it could affect investor confidence and potential challenges in raising funds. So investors will not want to invest in such a company when they look at their result that is too low. So that's the reason for a low return on capital employed. What are the causes and effects? A high profitability from operations is the cause of a high return on capital employed. So where you have a high rose percentage, let's say maybe from 50% or 80%, is as a result of effective cost control, price strategies. Efficient management of capital and asset is a reason. Growth in sales revenue related to capital employed are the reasons for a high return on capital employed. And what are the effects? The effect is it attracts investors. It suggests potential for return. So people who want to invest in such a company buy their shares because they see that they have high dividend or high returns on their investment. While a declining rose might prompt management to investigate areas for operational improvement. So a low one would chase away investors and providers of capital. And management need to look at areas of improvement to consider capital allocation strategies. So in conclusion, the ROAS is a valuable metric for assessing a company's financial health and operational efficiency. It's very important because looking at those that have injected the company with capital, internal and external, the health of the company and the well-being can only be measured by one of the very, very important profitability ratios, which is return on capital employed. Every venture an investor injects money in wants returns primarily. Aside sustainability, sustaining operations, you want returns for your investment. So the ROAS is a valuable metric for assessing this. It also, ROAS provides insight into how well a company is generating returns and help inform decisions regarding investments, financing, and overall strategy. So as chartered accountants, we need to monitor these rules to help business maintain a competitive edge and ensure effective capital utilization. So that's our job, monitoring these rules. What I do in the office here, we have a key risk indicator every quarter, which we monitor these ratios on a quarterly basis for our financials. It's very important. Okay, so having looked at ROAS, the next ratio is return on equity. I'll take questions on ROAS, the explanation. Don't forget your explanation is very important in the exam. Your calculation takes very low marks. So as we look at mock exams and other past questions to see how to tackle this, don't waste time on number crunching. Calculate whatever it is, and you cannot be accurate. Don't waste time on accuracy. Just make sure you have aligned, like all of us have closer ratios or results, 9, 10%. Okay, I've seen your hand, Salma. Please go ahead.
Okay, sir. I wanted to ask if we can get the slides.
Of course.
My network is low, so you would have passed some things. I can hear you, but I can't really see what you're talking about. So if later, I'll now be saying it.
Okay, fantastic. Sure. Julia said we should be sharing the slides. So after the class, we'll share it on the platform. Sure, you'll get the slides. Is it that you cannot see the screen? You can't see the screen. Yeah, you're welcome. You can't see the screen, right?
I can see it. It's low. I can see that we are in regular monitoring of rows. But the one before, I did not even see what was happening. So
apologies.
So you'd have passed the page before it go. But I can hear you. No problem with the network. Thank you, sir.
Okay, you're welcome. Thank you for that. So any other question? Thank God it's recorded, so we can just go back to the recording. Any other question on rows? Okay, so in the absence of none, I believe we captured that, and let's move to return on equity. Return on equity. So it's a variation of rows. So what's the simple calculation for this? You are only doing equity. You have nothing to do with debt. That's just it. You are excluding debt from this. So in rows, we calculated the whole capital employed. But in return on equity, we are calculating only equity. So it concentrates on the entity's equity holders and compares the equity capital with the amount of profit which can be attributed to them. Okay, so the ratio is calculated as follows. Profit after tax. Take note of that. Profit after interest, tax, and preference dividend divided by ordinary share capital plus reserves. You can see that there's no non-current liabilities, no long-term debt. That's because we are concentrating on equity only. Okay, so let's go and based on Dan Kabir, let's calculate return on equity. All right, so going back to the question.
Question, sir.
Okay, yeah, please go ahead.
I was asking, I said to ask, which of them do you advise us to use during the exam? If we have to choose, which one should we use?
Okay,
if the examiner doesn't ask us.
Okay, good question. So if the examiner doesn't ask us, we should use ROEs and ROE, return on equity. We shouldn't use return on asset. The next one, return on asset, is rarely asked after. So let's use return on equity. Return on equity and return on capital employed. Those two are very, very important.
Return on capital employed and return on equity. Okay.
Yes, please. Sorry, please. Okay. I think, okay, so we're talking about return on equity, and Julie asked a question that which one should she suggest? So, like I said in my last thoughts, return on capital employed and return on equity are very essential. So the next one is return on asset. So where you have options, Jinx return on asset is not that important. It's an internal ratio, but capital employed and equity is actually an internal and an external ratio. If you look at most publications on ratios in financial statements, they hardly use return on assets, but return on equity, return on capital employed are essential ratios. Okay, so after sharing my thoughts on that, let's go to the return on equity of Dan Kabir. So in calculating our return on equity, now there's a variation. I know I'll get questions on that. Now the total equity is inclusive of preference share capital because it was used and assumed to be an internally generated or special internally generated capital for the business. So in calculating return on equity, you add preference share capital to take note of that, because in our total we have total equity and preference share capital is part of the equity, even though it's preference. So we are taking the total. But let's go to our first variant, which is profit. From the formula, we have profit after tax and preference dividend. So what we do is our profit after tax is 77 million. We will still deduct preference dividend from that tax as a special amount to those providers of capital. So we take our profit after tax. Oh, okay. But this is for 2020, 2021. The examiner hardly pimps the questions like this, but I'm pimping it so that you can expect the worst case scenario in any examination. So I actually came up with this question, and I pimped it like this so that we expect the worst case scenario. So profit after tax, we have that. So let's less preference dividend. Don't forget, we are lessing preference dividend, if there's any. So let's go through Dan Kabir. I think there's preference dividend. It either comes at additional information or it comes as a current liability. So if it's a current liability, it has been provided for. So you can see under your current liabilities, you have preference dividend. It has been provided for, but it has not been paid. So 47,250 million is your preference dividend. So we go and we less it, and we have our net profit after tax, 77 minus 42. So we have 29,750 million as our net profit after tax. Okay, so let's go now to Dan Kabir and have our denominator, which is our total equity. So what is our total equity? Don't forget you have the beginning and the end of the year. So our total equity is 1.5 billion. So our total equity is 1.5 billion. Okay, so our return on equity is net profit after tax, after we deduct percent dividend divided by this. We have a very low 3%. Wow. Very, very low. Very low 3%. Okay, so as we can see, the return on capital employed, return on equity is 3%. So can we go ahead and do 2021 and 2022? If we don't have any questions. It's still on the call. Oh, we are only three.
Questions.
Okay, yeah, please go ahead.
Yes. I don't know. I just got distracted a bit. But for 2020, did you remove preference share capital?
Yes, I did. If you can see my screen, you'll see that preference dividend has been removed. Not the capital, sorry, dividend from the profit after tax.
What I have in front is some 7,000.
Oh, okay. So you have 77,000. You can see less preference.
Profit after tax.
Yes, profit after tax, 77 million. Then did you see less preference dividend? Can you see less preference dividend?
No, I can just see only 7,000. I can see 2021, 2022. That's what I can see.
Oh, okay. That means your screen has frozen. There's an update. Rufi and Aisha, what can you see on the screen, please? Are they still on the call? Rufi and Aisha, can you hear me?
Yes, I am. I can see the full screen, sir.
Oh, okay, fantastic.
So let me leave and come back.
Yes, if possible, please. Yes. Rufi, can you see my screen too? Hello, Rufi. Can you hear me?
Someone couldn't join because the network was bad also.
Yes, I noticed the network. She's trying to join. She's going off and coming back. Okay, so Julie is back now. Okay, fantastic. So Julie, confirm if you can see the screen.
I can see the screen now. Yes, please.
Okay, fantastic. Okay, so maybe Rufi is having a network challenge, or maybe she's... Sorry, I didn't catch your thoughts on that. What did you say?
Okay. I am just seeing the less preference dividends.
Oh, okay, fantastic. All right, so can we do 2020, 2020, 2021, 2022? We have Aisha, we have Julie. Can we test? Can we do that quickly?
Yes.
Thank God we don't have the second variant, so it won't take time like the last rows we did. So Aisha, can we test it?
Yes, I'm on it, sir.
Okay, fantastic. So let me hold on for you and Julie. All right, so let's go. 2020, 2021.
Hello.
Okay, Rufi is here. Hello, Rufi.
Yes, I'm here.
Oh, okay, fantastic. Oh, okay, welcome back. That's nice to have you. Okay, so please, we are doing return on equity for 2020, 2021, 2022. Let me get your figures for that. So we are holding on.
So total equity, you still added the preference share capital.
Exactly. So maybe you didn't catch me very clearly. I said in the calculation of return on equity, preference share capital is included because it's part of the equity that was provided. And if you notice, we are deducting the preference dividend, and we didn't deduct in return on capital employed because it was excluded in return on capital employed. So you have to include it in return on equity because it's considered part of equity and internally generated, though it's a special debt owed.
Okay.
But in the return on in the return on equity is calculated, so you see it in the total equity. I made that explanation. I'm sure network didn't allow you. You didn't hear it.
I guess so. Yeah.
Yeah.
So for 2021, I have 2.94%, and 2022, I have 3.09.
Okay, 2.94%.
And 3.09.
Thank you, Julie. Fantastic. Okay, so we're waiting for Rufi and Aisha. Let's be fast. 9:39. Okay, we have 20 minutes more.
My answers are the same as that figure. 2.94% and 3.09.
2.94% and 3.09. Okay, so two people have the same figure. 3.
Like I was saying, I didn't know I was muted. This thing is quite tricky. One has to remember that for return on equity, that these preference shares must be considered.
Yes, it's tricky, and yes, you have to remember. Though under exam conditions, if you don't remember, you may not be penalized. It's your interpretation that matter. But then, it's good. Yes. Under exam condition, it may not matter, but because how many marks does the appendix carry? Under exam, the appendix is your writing and convincing the examiner that carries more of the marks. Yes.
Okay, good.
Yes, exactly. If you can remember, it's also good. At least you have accuracy in your interpretation. Okay, so we're waiting for Rufi now. Julia and Aisha have the same figures. So let's see if Rufi has a different figure.
The issue with case study is not really the punching of calculators. It's not really the punching of figures. It's interpretation.
But I have my answers.
Exactly. Okay, Rufi, go ahead, please.
2021, I have 2.94%.
Oh, the same thing exactly.
22, I have 3.09, so approximately 3.1.
Okay, I'll go for your 3.09. Three of us have exactly the same figures, and I like that. Yeah, I like that. So let me just run through that and confirm. So our profit after tax, we have 84 and 97. So I picked that. It profit after tax, 84 and 97. Okay, so that's correct. Then let me go for preference dividend, which is under 51 and 591. So I take that and paste here. So I have $32 and okay. So my total equity, let me go total equity, two of them here. Okay, so percentage, exactly. So 2.94 and 3%. Exactly.
Approximation.
Approximation, yes. So Excel approximated it. So thank you very much for that fantastic calculation. Okay, so what does it mean? Now, the return indicates profitability of a company in relation to the equity held by shareholders. It shows how much profit the company generates with the money invested by shareholders, highlighting the effectiveness of management in utilizing shareholders' funds. So we want to see how management are able to use the owners of the company aside any external debt. And why are preference shares bought as owners is because preference shares are special. So they have a claim and you must remove their dividend from the profit of the ordinary shares. So you are including them in the return on equity if there is, though the examiner has not really tested preference share dividend. So in case it comes, just take note of that under exam condition. Now we have the net income as the profit after all expenses. Net income is your profit after tax. After all expenses, taxes, costs have been deducted. While shareholders' equity includes equity invested by shareholders, including retained earnings. So what are the implications? A company is effectively generating profit from its equity. It indicates strong management performance and it can attract investors looking for good returns. Yeah, so investors, ordinarily not debt providers, will also always like a company that makes profit from its organic income. Take note of that. A lower return on equity will signal inefficiencies or that a company is not effectively using its equity to generate profit. It could raise concern among owners of capital, ordinary shareholders, investors, regarding the company's operational efficiency. So one of the issues with return on equity is that there is no profit enough to distribute to shareholders. And shareholders and investors always look at it as operational inefficiency on the part of management. So when you are explaining this, take note of that. What are the causes and effects? A strong net income growth is due to effective sales strategies, cost management, and market conditions. So where there is a boom or the environment, internal and external, is okay, they will experience strong growth in revenue, and where you have cost management, effective cost management, cost to be reduced, they will have a bottom line because the profit after tax is the bottom line and is very important. Also, another cause of it is efficient use of assets and management of expenses leading to high profitability. Then reduction in the equity base through share buybacks and retention of earnings, which can also boost return on equity without increasing net income. So where there are share buybacks, ordinary shareholders buy back their shares, maybe that have been issued out to other share holders, maybe in form of right issue. So where shares are bought back, it can increase return on capital employed because the denominator has appreciated. So these are the reasons for a high return on capital employed. So the effects of also a high return on equities, it can attract investors and lead to a higher stock price. So where you have a high return on capital and return on equity, why am I mixing return on equity and return on capital employed? I'm mixing it up. All right, return on equity can attract investors and lead to a higher stock price in the market. So when we are looking at the investment ratios, we'll see how this graphically applies. This indicates strong financial performance and efficient capital utilization, while a low ROEs or low ROE may prompt management, to review operational strategies, cost structures, and consider restructuring to improve profitability. So the causes of a declining or lower return on equity has to be a review. So in this case of Dan Kabir, we saw it plateaued at a particular amount. We saw it 2020, 3%, 3%, 3%, just the same level, the same, no going up, no going down. So it remained the same at that capacity. Even though the percentage is low, it's still positive anyway. So looking at the cost structures could help mitigate the issue of declining ROEs, enhance operational strategies, and it will improve profitability. So in conclusion, return on equity is a vital metric for assessing a company's financial performance and the effectiveness of management in utilizing shareholder capital. It also serves as an indicator for investors when evaluating potential investments and the company's growth prospects. So a lot of people want to invest in the company, but the first thing they look at is the return on equity. It's a very vital metric. Return on capital employed and return on equity are very vital in assessing whether a company is viable for investment or not. So as chartered accountants, regular analysis of the ROE can help stakeholders make informed decisions regarding investments and the company's financial strategies. Okay, so we've looked at return on equity. Do we have any questions? Do we have any questions on return on equity? I believe this is one of this. Yes, please. Go ahead. Yes, please.
So with the 3%, which it showed stability, should I say, if I'm to interpret it now, can I say, am I right to say that their return on equity is low?
Exactly. I agree with your thoughts.
Effectively managing. Okay.
Exactly. I agree with your thoughts. So you are right. They are not effectively. Why am I saying that? Because if you look at the high, medium, low method, no matter the parameter, 3% is low. Even if you say from 1 to 10% or 1 to 20% is still low. So you are right to say that they are not managing. And for the first year is 3%. Second year, 3%. Third year, 3%. No. Who would accept 3% return on his investment as an equity holder? Of course, it shows management is not improving on their performance. That's what it means. Profitability is low. Costs are high. Because if you look at Dan Kabir, look at the financial statement. When we come to the issue of cost of sales, you see where the problem is. Now look at their cost of sales on the screen. If you look at the total cost of sales is 1.1 billion on a revenue of 1.3 billion. So you see that they are not effectively managing themselves. So when we come to other ratio calculations, we'll be able to point that out, that their costs are high. So from even the first level cost, the cost of sales, you can see is high. Though their admin expenses, distribution is not that high, their depreciation too is not high. So the first line of their expense is very, very high, which is the direct cost is high. So I agree with your thoughts on that. The return on equity is slow. You are very correct. All right. Any other question or contribution based on this? Julie, are you okay with the interpretation? You seem to be...
Yes, I am.
Okay, fantastic. What of Rufi? Are you okay with the interpretation? I hope Rufi has not slept off.
I dozed off a bit though, but I'm expecting the slides.
Yeah, exactly. I will share the slide. So it's 9:51. I will have said we should go for return on assets, but then we may have to continue in the next class. We have just 9 minutes, and I'm not sure we can calculate return on assets in 9 minutes. So we may have to close at this point, and we'll continue on Thursday.
You don't introduce it. Since we have 9 minutes, you can just introduce it.
Yeah,
since we
just
have 9
introduce
minutes.
it there so that we know what it says, interpretation and probably formula.
Okay, fantastic. Okay, that's good. I like that. Okay, so the return on asset is a crucial profitability ratio. It measures the effectiveness a company is using to its assets to generate earnings. So the effectiveness in generating earnings with the assets, the total assets of the company, and it also provides insight into the efficiency of asset management. So your total asset, including non-current and current, you're looking at this area of investment. Now, long-term current total assets are a long-term investment on the company's the company's, there's a word I'm looking for it to use, on the company's economic benefits. Yes, that's the word I want to use. So the long-term investment in the economic benefits of the company is what you use to generate returns. So assets are used to run the company, maybe for manufacturing company, production and all that, to in turn generate returns. So assets in comparison with returns is what this ratio is all about. So you are looking at asset management and how the company generates returns with that. It means that the percentage of profit a company earns from every naira invested on assets. That's what it means. So return on asset indicates the percentage of profit a company earns for every naira invested in asset. It reflects how efficiently management is using its assets to produce profit, showcasing the company's overall operational efficiency. So where we have assets being used and returns are generated, it shows the company is using, the management are using the assets very, very efficiently. Very important to note. Now, the bottom line is the calculation, which is net income divided by total assets. Net income, which is our profit after tax, divided by total assets. So we have the net income as the profit after all expenses, taxes, costs have been deducted. And we have the total assets as the sum of all current and non-current owned by the company. So you have your fixed, which is the former way we call non-current asset, fixed asset, and we have the current asset. Match them together, and it's the denominator to calculate the net income. So take note also here, you are not going to remove preference dividend. Why are you not removing preference dividend from the net income? Even though in the financial statements, you have preference share capital. Now, this ratio is an internal measure of management's capacity and efficiency. So it's an internal ratio. So when Julie asks that in under exam condition, if they ask you to choose profitability ratios, this ratio should not be chosen. It will just waste your time because it's an internally generated kind of ratio or a measure of performance. When you are calculating external ratios for publication to maybe the stock exchange, the company is a publicly listed company, the return on asset is not necessary. So they want to see return on capital employed, they want to see return on equity. Those two are very important. But when you have time, maybe because it's one of the simplest ratios anyway, it's just your profit after tax divided by your total assets. Simple. And you get the percentage of how much you've gotten in return. That's how to calculate it. It's a simple ratio. So a lot of people go for it under exam condition where they are not given options, or where they are given options anyway. And where they are not given options, they may decide to, the examiner may say, okay, ignore return on asset and do return on capital employed, return on equity. And most of the exams, you see the examiner always asking for return on capital employed and return on equity. So that's the brief introduction to that. We have 4 minutes. I would have loved us to calculate it, but then we may go more than 10 p.m. And this one, Julia started dozing off. Yeah, she's already dozing off. I can see we are only 2 self on the call. Everybody is tired.
Okay. A question. You made mention about preference dividend just now on the net income. Are we going to deduct it from it?
Okay, good. So why I made the comment is because it's an internal ratio calculation. So you don't deduct preference dividend. It's not necessary. Preference dividend is, yes. If you look at
preference dividend is a problem. Okay, since you said that they don't look out for the figures, it's just explanation, then it's fine. Because
so if you look at the preference dividend now, even if you remove it from the internal, it doesn't make any difference. Why? Because if management are measuring their capacity, they will not bring any external factors. You can look at it from that perspective. Yeah, so they don't bring any external factors. Yeah, so preference dividend is like an external factor, and that is why when calculating it, you are not adding preference dividend, but the internal issues after you've deducted your organic, inorganic, external, internal expenses is what you calculate. So return on asset is an internal ratio. So just look at it from that perspective, then you ignore preference dividend. But if you deduct the preference dividend, the examiner will not penalize you. It will just reduce your percentage. That is it.
Okay.
Yeah.
All right, sir.
Okay.
Thank you, sir.
You're welcome. Aisha, any other comments, any questions so that we can shut down? We have like 2 minutes.